Hey guys, welcome back to another video here with Financial Hub, and this video is brought to you proudly by PaperStone. Cool. So this is the second part of the risk management plan that we started in the previous video, and I hope you got to follow what I was saying. We talked about two main things: risk per trade and losing streak. Now, those are just topics on its own. If you watch those videos, you can see how in-depth I got in talking about those risk managements. Okay. Now, today's risk management I want to talk about is daily and monthly risk limits depending on the account you're trading. So we already talked about risk per trade, okay, and losing streak. Okay. Now today I want us to talk about daily and monthly risk limits. Now I have a risk limit. Let's talk about what I've written first, of 3% maximum on FTMO daily. Okay. And I have a 4% risk on my own personal account with PaperStone. This equates to a maximum of 2 trades per day. So let's say, for example, remember in the previous video I talked about FTMO only trading and risking between 1 to 1.5. So if I have 2 trades that I'm risking 1.5 and 1.5, my maximum trading risk is 3% maximum. So at any given time, I only have 2 trades running at a time. I only trade 4 pairs, so it's very hard to find me having all those trades at the same time. 3 of them are quite similar. The 3 indices, the 3 main indices in the United States. That's the US 30, US 500, and US 100 NASDAQ. Okay, they're sort of similar. So it will be quite hard to find me with all 3 trades running at the same time. It can easily find me having one of the indices and maybe gold running at the same time. But most of the time with my new updated trading style, you'll always find me having 1 trade running at a time. I rarely have those trades all running at the same time. Those days come and there are those opportunities, but most of the time I normally have 1 trade running at a time. But when I have an opportunity where I have another trade, I can only have 2 trades running at any given time. Okay, so my maximum is that, and on my personal account, remember I said my personal account maximum limit per trade is 2%. So if I have 2 trades running, I have 2 trades, which is 2% times 2, which is 4%. Now mind you, I never have many trades running or many different pairs. This is another psychological protection I give myself. I'm not too good with having too many trades running at the same time, because I discovered a while back, and this is just things that you keep working on yourself, and I'm working on myself. There's a time I used to have I had 8 or 9 trade pairs running, not running but trading at the same time. So at that time you would easily find a trade risk of give or take, you have 3 of those pairs opportunities at the same time, for example, different, uncorrelated and all that, and you take those 3 trades. Or even they could be correlated. Let's say Aussie dollar, or let's say Euro USD and GBP USD, which are almost quite similar, have the same setup or same setup that I'm looking for, and I take both of them at the same time. Now what used to tend to happen is that one trade will affect the other, not in terms of how they're running, but in terms of how they're affecting me psychologically. Let's say Euro USD gets some news of the Euro pair. So the Euro won't really affect it. It could affect the GBP, but this is more specific on the Euro. Euro gets some news, volatility comes out on the Euro pair, spikes my loss. GBP, yes, gotten some volatility, but hasn't hit my stop loss yet, so it's still fluctuating. But what do I conclude? I say, okay, if Euro USD fell and it got me a loss, maybe it was long, then I sort of conclude in my head GBP USD might do the same thing, and I end up I remove manually, I take a manual loss. I tend to group my losses. We'll talk about this one in terms of my journaling. I take a manual loss of GBP USD. Okay, is that good? No. Why? Because it could be a volatility that spiked market down, got some liquidity, market starts to move up, and which affects the GBP USD pair as well. So when I just come out, that's when you start asking yourself, what did I just do? Was the devil watching me? Why am I a victim of the market? Why did I take my loss? So you start beating yourself up. You start asking yourself, do I go back into this trade? I took a loss that I wasn't supposed to make a loss. So it's all that sort of back and forth fight with yourself. So I tend personally to avoid taking a manual loss, especially if that trade was pre-planned. I follow the pre-plan, I follow my backtest data, I follow my trading plan, I follow my risk management plan. When I took that trade, I had accepted the risk. Treat those pairs differently. We've partnered with Paperstone, one of the world's leading forex brokers, my personal best, to bring you an exclusive opportunity. And trust us, you won't want to miss out on this. We're giving you the chance to learn forex for free at Financial Hub, but there's a little twist to it. All you need to do is fund your Paperstone account, and boom, you're all in. Deposit $100 and get access to our basic course, perfect for beginners. Or deposit $250 and get access to our exclusive course that is best for advanced traders. Why is this huge? Because you get to learn while you earn. Trade the real money and get real experience. And also you get lifetime access. Once you're in, you're in. Now, mind you, sometimes you might find that actually works in your favor. You come out of that loss and markets end up going to the downside, and you say, oh, thank God I came out earlier, I'd have lost much more than anticipated or that at risk. But my friend, when you took that trade, you had those in plan. Now for me, I tend to really avoid fighting with my trading plan. I don't trade that much. Okay, so when I take a trade, I've really gone down to the nitty-gritty of the reason why I've taken this trade. So I am strong and convicted about that trade. I don't really force the market. Okay, I don't force the market in a way that, yeah, I have to be right, I have to make this money and all that. I push myself to take the right trades. So for me, I don't risk that much. I take that monthly, weekly risk, daily risk limit, okay? And then I have a monthly risk limit of capped about 5%. Now, my daily risk limit is more or less similar to my weekly risk limit because I don't trade that much. I'm a swing trader. I only trade 4 pairs. So you'd find that in a week, if I have a good opportunity that has formed at the 4 hour, it'll be mostly just that 1 or 2 trades. So my daily risk, I can even put here, it's sort of daily stroke, daily stroke weekly, okay, risk limit. It's more or less the same. And then I have a monthly risk limit capped at 5%. So if during the month I have 5% loss, okay, broken down into weekly risky plan, like a weekly risk plan, okay, if I hit 5% drawdown or for the month, I stop trading and evaluate and enter evaluation mode. I need to evaluate myself. Now, is it a bad thing? No. But could a correction be made? Could an update be made? Could I learn from the losses I've gotten to my 5% loss? Yes. Is taking a break a good thing? Yes. Most people believe taking a break is not a good thing because they think, okay, what's going to happen? I need to trade. I need to make this money back. No, money is made in the sitting tight. Money is made when you're doing the things behind the scenes. Money is not made when you execute. Messi and Ronaldo don't make their millions when they're actually playing the game. They or rather hone their skills. Rather, that's what I wanted to say. They don't hone their skills by just playing the live game. You have to practice and practice what you do behind the scenes. So that's the same thing I do. Behind the scenes is what I do at the end of the day. So my daily, weekly, and monthly risk are controlled. So I don't just get into 5% and just continue trading. No. Sit down, evaluate, replan, and come back and cut my risk, of course. So I'll have cut my risk, of course, if I get 2 trades losses in a row, and then reevaluate myself. The next thing I do, trade management rules. Okay, this is the last one I'll talk about today, and the rest come for our weekly webinar that is proudly brought to you by Paperstone, and I'll tell you much deeper about that next week at this coming Thursday. Okay, so I do not scale into trades. No adding to winners or losses. I do not scale losses. I do not scale winners. I keep it as it is. So I have and that's for my current trading state. Remember, and I keep saying this a lot, we evolve as traders. The markets evolve, our systems evolve, our trading plan evolves. And that's why I said it's a never-ending journey. So what I say now is not fixed, it's not cast in stone. I might continue backtesting, learning a few things, observing new things, and that might come into my plan of how to scaling. But at the current moment, I do not scale into the market. I leave it as it is. I keep it fixed. Okay? I never add into losses or winners because if I do that, okay, I have no trading plan for that. I have no risk management plan for that. I have no trade management plan for that. So if I do that, I cannot control my psychology properly, control my risk properly, okay? Because remember one thing, okay? When you're having trade management with things like prop firms, if you scale in, you're going to incur bigger losses. Now remember, there's a daily limit loss, and those daily limit loss are compounded, or how can I say, not compounded, they tend to be reactivated every 24 hours. So if I'm trading and I have a 1% risk, okay, or let's say I have a 2%, whatever, let's say 1% risk, I have 2 trades, so 2 trades are running at 1% risk, so that's a total of 2% of my account is in the exposure, okay? If I have those 2 losses, I lose 2%. Now remember, it is activated and updated every 24 hours. It is sort of like a trailing daily loss limit, in that if my trades are running at 2% profit, remember, at first when I took the trade on Monday, okay, my risk was the 5% total was to be lost on that Monday. So my account risk for the day maximum loss is at $9,500, which is a $500 loss. Okay, so if I lose more than $500 that same day, my account is gone. But that is depending on my account balance, so it will be at $9,500. Now the next day, let's say I have a 4% risk profit running. Okay, I'm trading, my account is trading at 10,400. Now my risk of my account has been brought up to 9,900. It's not anymore at 95. Okay, it's at 99, meaning if I lose my my current running profit, including my the 1% that is left, then my account is gone. So it's sort of updated and it follows the market every single day. So I do not scale into trades, so no adding into winners or losses. When a trade moves 50% towards my target, remember this is a trade management rule, I execute 2 actions. I move my loss to break even, so that's part of risk management and trade management. So when market moves to 50% towards my target, I eliminate capital risk, not trading risk. So I normally see, and I personally am a victim of this, when we used to trade long time, I'd easily say my loss, I'm having a risk-free trade. You never have a risk-free running trade unless you don't have a trade running at all. The only thing I eliminate is capital risk. Remember, you have profit risk, because if I decide to close that trade running, that is addition to my capital. Okay? So you can't equate and say this is not a risk running, my trade is running risk-free. My friend, that profit running is actual risk. If you lose it, you've lost, because you'll sit back and beat yourself up for losing that profit that you had. So I move my stop loss to break even to eliminate capital risk. So the initial capital that I have, I've sort of controlled it. Now what I need to manage is the running profit trade that I have running. So I close 50% of my position. This locks in partial profits and protects against sudden reversals. We've seen this many a times. I've had this many a times. My backtest has showed me this many times. The market can easily run towards your target just for it to quickly be overturned by certain news or events or anything, or just the market volatility itself, and quickly go back to your stop loss. Now for me, when market moves 50%, the plan is to lock in partial profits that protects me against sudden reversals. Now, when market starts moving towards your target, we start changing our initial risk, our thought process from when you are sort of neutral to start becoming more hopeful. Okay, so you start becoming hopeful that the market will reach your target because it is much closer. Now that is not a mindset you should have when you're trading the markets. Just because it is closer doesn't mean it's a guarantee it will be reached. At the end of the day, you still need to manage that trade as best as you can. Okay, so for me, that's the trade management rule I have. Number 1, break even. Number 2, close 50% of the position to lock in part of that partial profit that I have running. Okay, and like we say, the saying goes, haba na haba hujaza na kibaba. You'll be shocked how much that locking in profits can amount to at the end of your trading period. So through backtesting, I found that my setups hit halfway to target before reversing. This rule keeps me from going back from giving back early wins. So the rest, as I've said, which I'll get deeper into, and I don't want to scroll lower, but you can see there's still all these topics that I have down here. I'll talk about them in the upcoming webinar that we host here at Financial Hub, thanks to Paperstone, that will be coming every week. So make sure you come for that one so that you can ask me questions, we can interact, we can have a live trading interaction and analysis together and talk about this, because many things that I've covered here, some of them is not what you're looking for. Maybe you have a question about something and it can be sort of a symbiotic relationship. Just because I have a couple of years experience doesn't mean I'm not learning even from you yourself. So if you come for that session, I can also learn from you, and from what you tell me, Caleb, look at it like this, what do you think about this? Sort of, it can help me implement it into my own management plan, into my own risk management plan. So that's it for today. Hope you've enjoyed this week's topic on risk management. And risk management 2 will come very soon. We'll come and talk about that in another video. But so far, so good, and I hope you've enjoyed that. So without further ado, that's it from me this week. And like I always say, stay woke, stay financially literate, and I'll see you in the next video.